Hey, folks, I know there's a lot of people that are kind of excited about today's episode. We're going to be discussing indexed universal life insurance. There's a lot of misinformation out there, both on the pro side and the con side, and we are going to do a deep dive into this. It's going to end up being a three-part series. We're going to go over the good, the bad, and the ugly in part one, where we talk about the design of a policy, what situations work good for this type of a product. And we're going to get into what to look for in it, as well as we're not going to shy away from any of the negative stuff. When it comes to the IULs, we are going to face them head on. Hopefully, when you get done watching this series, you will have a better idea of whether an index universal life insurance policy or an IUL is right for you. Now, in part two, we're going to look at some example policies. I'm going to show you what a bad policy looks like, what a okay policy looks like, and then what a maximized, optimally designed policy will look like. So you'll be able to tell the difference. The current plan is that I will just do that with one life insurance carrier, but when I get to part two, I may end up doing a couple of different life insurance carriers just so you can see it. Or maybe I'll just add them in additional videos. My goal is to not make these videos so long. I want to break them up into bite-sized pieces so that you can digest them, have some time to think about it, move on to the next one, and not have to spend all day in front of the computer if that is not your desire. So with that said, let's talk about index universal life policies.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Is an index universal life policy right for you? I made a sheet that talks about all of this stuff. So I'm going to put this up on my computer screen and we're just going to go over it. But I think it's nice to be able to look at it while I'm talking. So if you're a reader, you can read it. If you like to just listen, you can listen. Maybe it'll do good for you to see it and hear it. So whatever your flavor, hopefully you'll be able to follow along. Okay, so is an IUL right for you? I got to say it depends on what you expect or what you need it to do. So the financial gurus tend to hate on every type of permanent life insurance policy, whether it's index universal life or whether it's whole life, whether it's universal life or whether it's variable universal life. In my opinion, I think that's because, one, there's a lot of bad products out there and there's a lot of bad salespeople out there. And these guys are going to try and sell you this stuff by hook or by crook. Okay. There's no getting around that. There's definitely some unscrupulous people that end up in certain fields. I wouldn't say that most life insurance people are that way because that hasn't been my experience. I think people care, but I think that sometimes that they're uninformed by the companies that they work with. They don't train them in a way that benefits the client the most. They train them in a way that benefits the company the most. On top of that, these financial gurus often have their own biases at stake. A lot of these folks get paid by you investing with them. So it's in their interest to turn you off of other products that you might put your money towards, as opposed to utilizing a life insurance policy. I'm not going to get into that today as far as who pays more commission, who ends up walking away with more money. Everybody has to work for a living. So I would say whatever product you end up deciding to go with, just make sure that it fits you and don't worry a whole lot about who's getting paid to do it because nobody works for free. So we will just consider the good and the bad and just assume somebody's going to get paid to set you up with that type of a product. That's kind of the best way I can say to look at this. So in my opinion, when it comes to index universal life policies in particular, there's a few good products out there that can function very well if they're designed properly. In order to take advantage of everything that an IUL has to offer, I think you probably need to be under the age of 45 as well. And I'll get into more of that when we talk about the design. I'll get into why that is. Essentially, you're going to need time with an IUL to let it grow in cash value while the cost of insurance is low. And as you get older, that cost of insurance goes up in these types of policies. It's quite a bit different design from a whole life policy. And I'm going to be doing a video that compares the two side by side. That's coming up soon, but I'll do that after I finish this 3-part series. So the key to a good IUL design for cash growth. Number one, you want to have an increasing death benefit. I'm going to show this to you more in part 2, where you'll get to see the different designs, but you essentially have a level death benefit or an increasing death benefit as an option. And when it comes to an optimal design for cash growth, you want to go with an increasing death benefit. This allows for a design that gives you the lowest base premium and the highest amount of cash growth, so that you can max overfund these policies by four times the base premium, and staying below that MEC limit. The second thing that we want to look for is you want to make sure it has an overloan protection rider. The overloan protection rider is one of the biggest concerns with these policies. The value in this overloan protection rider is it allows you to trigger it between age 65 or 75 or older, depends on which carrier. But what it does is it turns off the premiums. It turns the policy into a paid up policy. So it's kind of like using a reduced paid up when it comes to whole life insurance. The nice thing about this one is that the premium costs don't start to jump a lot until after age 65 or 70 with these index universal life policies. And with this overloan protection rider, you basically borrow out all of the funds that you can. You turn on the overloan protection rider, and you're essentially turning off the premiums before they get too high. It does it for you without you actually withdrawing the money from the policy. And so there's no tax consequences here. The policy is not going to implode, leaving you with taxes owed. So the overloan protection rider puts the onus on the carrier to handle the policy premiums from then on, so that your policy won't lapse. I'll talk about that more in our second video of this series, when I go over the policies and I will show you exactly what it does. So the third benefit to the IULs, the key to a good IUL design, is living benefits. You want to make sure you get as many living benefits as you can. These give you the ability to accelerate up to the full death benefit prior to actually passing away in certain situations. So if it comes to terminal illness, critical injury, these are things that will trigger a living benefits rider and allows you to tap into that death benefit, so you don't end up running through your savings and hurting your family basically before you end up passing away. So it can be really, really helpful to have access to that death benefit before you actually pass away. Now, let's look at the pros and cons of the IUL. The advantages to the IUL for the cash growth. This speaks to the design as well. One, it uses annual renewable term insurance for the base life insurance costs, which is really inexpensive when you're young. This was why we talked about wanting to be under the age of 45 when you get these. The cost of annual renewable term insurance goes up every single year you're alive. And when you get to 65 or 70, a policy that when you were younger might have cost a couple $100 a year is now going to jump up to $1,000 a year, and then $2,000. And by the time you get to like 80, that policy could run $40 or $50 or $60,000 a year. That's how those premiums work. The higher the likelihood that you're going to pass away based on your age, the higher the premiums are going to be. This is why that overloan protection rider is so important. So when the policy is inexpensive, when you're young, more of your premium payments can go to accumulate cash value. And so with this policy design, I'm typically able to get you around 88% cash value in year one. That's solid. Number two, Growth is tied to an index. So indexed universal life. That means it's tied to an index, typically the S&P 500. It's not directly invested in the stock market. It's only tied to that index. And what that does is it allows the insurance company to credit you based on the market gains while insulating you from any market losses. So if the market goes up 10% for the year, you could get credited 10%. But if the market drops 50%, you don't lose anything. You get zero credit on that one. Means it's not going to go up or it's not going to go down. A lot of people like to say zero is your hero in that case, because while the stock market is imploding, you don't have to worry about any of your money being lost. You have a guaranteed floor of zero each year that the policy is in effect. Now, some policies, it depends on your carrier. Some policies may give you a 0.25% guarantee. So you know it's going to go up every single year regardless. Some of them out there have a 1% guarantee. There's typically other caveats that are out there when it comes to insurance companies. The higher those guarantees get, when it comes to these types of policies, there's probably fees somewhere else because they're not in the business to just give this stuff away, okay? You want to know everything about the policy design, the good and the bad, for whatever carrier you're going to choose from, okay? Number 3, any gains that you make in your policy are locked in each year, and it creates a new floor for that cash value. So the only thing that can reduce the value in your cash value account is the cost of your insurance. There are some exceptions to this rule. Some carriers charge you, well, I'm going to go over this part in the cons, but some carriers charge you for certain things other than the cost of insurance, but not all of them. So in this case, in an optimally designed policy, the only time you're going to be able to lose money in your account is when you have to pay out for the cost of insurance for that year. And like I said, when you're younger, it doesn't cost very much, but when you get older, it starts to cost a lot more. So you want to make sure you get your cash growth before then. Now, what does this mean when I talk about gains are locked in and it creates a new floor for the cash value? Well, it ends up being what looks like a step where you have the current value and then the market will go up. You get to take advantage of it as it goes up. If the market goes down or stays the same, your value stays the same. So if you're looking at a graph, you're going to see what looks like steps that only go up. So when it comes to index universal life insurance, the wonderful thing about this is you will never see it go down. As long as you're not getting charged for the cost of anything other than the insurance, and you're not old enough that the insurance cost is going to be greater than the cost of your potential gains. Yeah, that sounded like a lot of caveats in there, but as we get more into this, you'll understand what it looks like and what I'm talking about. It won't be so confusing. Number 4, you have access to the cash value tax-free through policy loans. So when it comes to indexed universal life insurance, it's just like your whole life policies. Any cash value that grows within the policy, you have access to that through policy loans. This is how you can access the equity growth in your policy without having any tax consequences, okay? If you think about pretty much any other loan that you take out in your life, when you borrow that money, it's not considered income, okay? So it's the same thing in a life insurance policy. As your policy grows in cash value, you can borrow against it. It's going to grow tax deferred. You can borrow against it without paying any taxes. Number 5, loans can be variable rate or fixed. The choice is usually up to you, and which one you would prefer may depend on whether you plan to pay back the loan or not. So possibly early on in the policy, you may go with a variable loan if the rates are good, knowing that you're planning to pay this back. Now, when it gets closer to retirement time, or when you're in retirement and you want to start taking loans out, These are loans that you're not planning to pay back. You just want to start accessing that cash value for the rest of your life. In that case, you would probably want to go with a fixed rate loan so that you don't have to worry about what the market is doing. You don't have to worry about any variable rates going up higher than expected and hurting the cash value that you end up having available. An ideal policy, you have the choice of using either a variable loan or a fixed rate loan when it comes to index universal life policies. And you can switch. So if you have loans out that are variable rate loans, as soon as you get completely paid back, the next loans you take out, you can make those fixed rate loans. If you have fixed rate loans, each loan you take out while you have loans out already are going to be the same type. When it comes to the types of loans that you get, though, whatever loan you have that's outstanding, the next loan that you take is going to be the same type of loan. So if you have a variable rate loan already and you borrow again, it's going to be at a variable rate. If you have a fixed rate loan already and you borrow again from your cash value, it's going to automatically be a fixed rate loan. You can't have a fixed rate loan and a variable rate loan out at the same time from the same carrier. Okay. Number 6, it can be a great, safer alternative to market risk. It does carry some risk, which I'm going to go over in the next section of cons. So I wouldn't recommend this as the only place to put your extra cash, but it can be a good supplement for retirement savings. This kind of speaks to the situations where I would say I would recommend an index universal life policy. I wouldn't recommend it if it is the only type of life insurance policy you have, or if it is the only type of investments that you have, or the only type of savings that you have. This is not the vehicle for that. This product, in my opinion, is best used as a replacement for actually investing in the stock market for people who do not want to have the risk of the ups and downs of the stock market. This is ideally for people who want the opportunity for greater gains, but don't want to have the risk of the losses. So this isn't a type of policy where I'm going to suggest that you put all of your extra money into. I think that would be bad advice. There's people out there that are willing to give you that advice. Okay, these are the bad salespeople, and this is why this kind of gets a bad rap at times, because people aren't realistically looking at these things. So I personally have some index universal life policies. I also have some whole life policies. I have substantially higher death benefits in whole life policies and substantially higher premiums that I put into whole life policies than I do in index universal life, because they serve two totally different purposes. So the amount that I have in index universal life, I consider the money that I put into my index universal life policies to be an investment. Okay. The money that I put into my infinite banking policies, my whole life policies, I consider those to be more savings, more places to store cash while I look for other investments like real estate. That's how I differentiate the two. So definitely something to keep in mind is if you currently have, let's say, you're putting your money away into a retirement fund, such as a 401k or an IRA, you are at the risk of the stock market, right? So you have the opportunity of maybe going up 20% in a year or going down 20% in a year. Me, I'm kind of conservative when it comes to socking away a whole lot of money, like what happens in retirement accounts. So for me, it made more sense to go with an index universal life policy where I could get the gains of going up 10 or 11 or 16%, but I don't have to deal with the losses. And if you look at the long-term results, they're pretty satisfactory when it comes to the evening out. When you don't take any losses, the growth happens. The compounding growth still happens, and it looks really, really good. We will go over that more when we get to the second and third video in this series, and you can see the actual numbers on how they perform. Now, number 7 on the pro side, we've got extremely flexible premiums. You can pay the base premium of the policy or any amount up to the MEC limit in year 1. After year 1, you can pay any amount as long as you've overfunded it. You can pay any amount from $0 all the way up to the MEC limit. Now, obviously, the best cash value comes from max overfunding of this policy. Overfunding it early is what allows you to not pay any premiums if you need to later on. And the neat thing about these policies is you can always catch up at any time all the way up to the MEC limit. If your MEC limit is, say, $10,000 a year, and you've been putting in $1,000 a year for the last 3 years, you're going to have $9,000 extra dollars from each of those 3 years that you can catch up. So you could put an extra $27,000 into that policy if you wanted to. That's kind of a big difference from how a lot of whole life policies work, the infinite bank policies work. Those ones, some of them will allow you to catch up quite a bit, but if you've gone a number of years without contributing extra, they lower the amount that you are able to suddenly put into the policy. That's not the case with the Index Universal Life, so it does have a lot of flexibility in that case. And number 8 in our pros list, it's very similar to a Roth IRA. The growth is tax deferred. It can be accessed tax-free through the policy loans, and you can withdraw up to the basis with no tax consequences. Okay. What we mean by basis is how much have you contributed to the policy. All of the premiums that you've paid into it count as your basis. You can always withdraw what you've contributed and not have any tax consequences. Okay. But if you have growth in the policy and you actually withdraw that and not just borrow against it, you end up having to pay capital gains tax. Or possibly, if you've triggered your MEC limit, you may end up with early withdrawal penalties as if it's a retirement account. So there's some dangers if you end up putting in too much money. But that doesn't tend to happen because the insurance carriers really don't want that to happen. Some of them outright will not let you make a deposit that puts you into MEC, and other ones will let you know about it. If you try and give the deposit, they will reach out to you and say, hey, did you want to turn this into a MEC? Because that's what this payment will do. And you would tend to have about 30 days to back that up and get that out of there so that you do not exceed the MEC limit. Okay, that's our list of good. Now, how about the cons? What is the bad and the ugly when it comes to IULs? We're going to go over the disadvantages now. So, number 1 in our disadvantages, it uses annual renewable term for its base life insurance costs. Young folks may see a couple $100 annual cost, but somebody in their early 70s will see the same policy jump up to $1,000 to $5,000 annually. Then in your 80s, it goes over $10,000. Now this is for small amounts of insurance also. I mean, if you have a fairly high death benefit, those costs can really skyrocket. I've seen an annual premium for somebody in their 80s that is $80,000 a year, and that's for like a $500,000 death benefit. They really, really jump up, and it keeps going up from there. It gets very expensive. So if you've got the growth performance when the premiums were very small, then it might be worth it to continue paying those high premiums. But this is where I say either way, it's best to have that overloan protection rider in your pocket. So if those premiums do get up higher than you want to pay for them, you can always withdraw up to 95% of your cash value that's available and then turn off those premiums. That's what the overloan protection rider allows you to do. Number 2 in our cons list, it must be designed properly to get the most value. So this requires you to be knowledgeable about what you need. Do not just rely on a salesperson to, 1, know how to design it, or 2, design it with your best interest in mind. You do not want to just rely on the salesperson to be able to do that. A properly designed policy will minimize the insurance cost, which in turn minimizes the commission to the agent. Okay. All of these policies that I design for people are designed to pay me the lowest commission possible that the company is willing to accept, because that keeps the cash value in the policy. That is to your advantage. So complaints about large commissions are pretty baseless when it comes to a properly designed policy, as the commission can be up to 1/10 the regular size of a commission. So the policies that I design, the bulk of what an agent gets paid is based on what the base premium is. If you're wanting to pay $6,000 a year into your premium, we want to design that policy so the base premium is about $600 a year, not $6,000 a year. So if you have an agent that is putting a base premium at $6,000 a year, that's not optimally designed for your benefit. That is designed for their benefit. Okay. Number 3, growth is not guaranteed. Okay. This is one of the cons. The growth in your policy is indexed to the stock market in some fashion. So the growth is going to depend on market performance. Now, historically, the stock market has tended to go up. Okay. But it doesn't always go up. So there's a risk there that you need to be aware of. But when the market goes down, your value doesn't go down. You get that floor of 0%. Okay. And when it goes up, you go up. So number 4, when we talk about going up, the growth potential. The growth potential is capped. Almost every IUL out there offers capped indexes, which means, let's say it's indexed to the S&P 500. If the S&P 500 goes up 20%, you might have a cap of 12%, in which case, if the market goes up 20%, you get 12% growth. If the market goes up 100%, you still get 12% growth. If the market goes up 10%, you get that full 10% because you did not hit the cap. Okay. So they set these limits based on either a hard cap or by using a participation rate or both. So as an example here, you might have a 10% cap, meaning if the market goes up 12%, you only get credited 10%. Now, if you have a 50% participation rate, the market goes up 12%, you get credited with 6%. Now, sometimes there might be an uncapped index, which is set to a participation rate. In this case, if the market goes up, if your participation rate is 50%, the market goes up by 50%, you get 25% growth. So there's different situations that work better than others. And you usually have a number of different indexes that you can choose from. But all of those different options carry a little bit of risk, because for the amount you choose for one option, you can't put that same money into another option. So you're kind of rolling the dice on whichever option you choose. So what I tend to do is we just look at the historical averages, and we're just going to pick the best one and stick with it. Okay. Unless for some reason you get an inkling that you're going to be better off changing, you usually do not want to try chasing high interest rates each year. That's usually a recipe for disaster. Okay. So it's important to make sure that you do use a carrier with a long history of keeping those cap rates steady, keeping them stable, and has high customer satisfaction. Because some companies out there will offer a really high initial rate and then drop it. If you have a company that has a history of really moving those caps a lot, odds are they're not operating in your best interest. Okay. When it comes to a good company, just because they can drastically lower the payouts does not mean that they will. The best way to protect against that is to look at their track record. Okay. The history of a company is going to be the best way. Number 6, costs. Typically, there's only a few costs to this type of policy. That would be insurance. You got annual renewable term, remember. You've got administration fees. Typically, those are $75 to $85 a year. You have load fees. So anytime you make a deposit above the base premium, when you make that deposit, there's what's called a load fee. And that varies depending on the carrier. But you might have a 5% or 8%, or I've even seen some that are 15% load fees. I tend to not work with those kind of companies because I think that's a bit excessive. Typically, the companies that I work with are between 5 and 8% for that load fee, and you can usually make them up pretty quickly because the caps are very good on from these companies. Some carriers will charge you for participating in an index. These are not the carriers I tend to use, but you need to be aware that they're out there. There's a company out there that last I looked gave you a 1% guarantee for the floor, but they charge you 2% to participate in an index, which means if the market drops for a year, you end up losing 1%. You don't have a guaranteed 1% growth because they're going to charge you for that index option. I really don't like those ones. Okay. It's basically a way to make money off of you, even if there are market losses. Avoid those products. Okay. It's just like charging you an investment management fee. There's no need for that. There's plenty of great products out there that don't do that. Okay. Number 7, exceeding the MEC limit triggers terrible tax consequences. The good news is that good carriers will not let you exceed the MEC limit. I talked about this a little bit earlier. They will automatically reject any deposit that will cause you to exceed it. And with other carriers, you do get some time to fix it prior to the policy becoming a permanent MEC. Still, it is best to work with a company that won't let that happen anyways. Okay. Number 8, you have to use after-tax funds in almost every case. So it's not like a retirement account where you can put in pre-tax funds. You do have to pay your premiums with after-tax funds. And I say in most cases because I do have a video, and I will put that video up here that talks about how you can contribute to life insurance policies with pre-tax funds. There's a few different ways that you can do that. So check out that video. But just know, for the most part, what you're going to pay your premiums with is going to be after-tax funds. So I think that should cover it pretty well. Let me know if you have any questions or if you think that there's something that I missed. Bottom line, this can be a good place for some safe, tax-advantaged growth. I think what I would like you to go away with when it comes to index universal life policies is it's critically important that you have a proper design and that you're working with an agent that has your best interest in mind. Okay. I am a life insurance broker, which means I'm contracted with about 24 different companies. I think 24 last time I counted. But they don't all sell good policies. Okay. They specialize in different areas. There's companies that specialize in insuring certain medical conditions that other companies won't touch. There's other companies that specialize in offering good index universal life insurance policies. There's other companies that don't. Okay. There's companies out there that only have what's called captive insurance agents. That means they only allow their employees to sell their insurance. So they are not going to be able to shop around to get you the best deal. They're stuck trying to sell you on whatever product they have access to. Okay. Doesn't mean that their product will be bad necessarily. It just means that they don't know. You can certainly get estimates from them, find out what their products can do. But I would always recommend checking with a broker also. You don't ever want to only talk with somebody who has one insurance carrier to choose from. So I was talking about, I have about 24 different companies that I'm contracted with. I also have a couple of companies that are really good at offering whole life. Now, the company that I recommend for IULs, they sell whole life insurance, but it's kind of garbage. I can't design it to function like I can a whole life policy from Guardian or Mass Mutual. Guardian and Mass Mutual are the two whole life companies that I find to be the most flexible and offer the best types of guarantees and the best historical performance. Companies that offer the best IULs, one of them has been around for quite a long time, but their whole life policy is just terrible. They're, for one, they're not a mutual company. So not being a mutual company, that means dividends that they're going to pay out end up going to stockholders before they go to policyholders. So the advantage of whole life is the growth from whole life comes from being a part owner in that company. When you own whole life, you own some of that company. So what we want to do is for whole life, we want to use mutual companies where you're part owner of that company, and any profits of that company each year end up going back into the policyholder's hands. When it comes to stock companies, they have stockholders. Any profits are going to end up being split between that company and their shareholders and the policyholders. So what I see when I do their whole life insurance illustrations, I see really low dividend rates. But the IULs are not tied to that. An IUL is tied to the stock market. So you can get really good growth. When you're tied to the index, that's the only thing that's going to determine how much you end up with cash growth each year. You don't have to worry about profits going to shareholders. Or when it comes to finding the best carrier, you want to make sure that one, you have the right carrier, you have the right product that that carrier has, and you get the right design of the right product that that carrier has. Okay. And then your salesperson is designing it to benefit you. Those are the keys to that. If you have any questions about that, feel free to put them in the comment section below. You can always give me a phone call. I'm available. You can look at my Calendly schedule. The link will be right up there. Well, the link will be right up there to my video on scheduling a call with me, but there will be a link to my Calendly in the show notes right below this video. So you can click on that link. You can see what time is available. You can schedule a 20-minute phone call with me. I'm happy to chat. You can also converse with me by email. That works really well also. I'm happy to interact with you however you prefer. But yeah, if you have any questions, don't hesitate to ask. I'm more than happy to help you out. Even if this is not a product you want to buy, if you just want more information on it that I somehow missed in this video, definitely hit me up. Keep an eye out. Part 2 and part 3 will be coming up. Again, part 2, I'm going to go over specific illustrations that show different types of policy designs so that you can understand what you're looking at. Whether you're working with me or you're working with somebody else, you will know what to look for when it comes to index universal life insurance policies. Be sure, if you found value in today's video, be sure to give me a like and subscribe to the channel so you can follow along as we have more videos come out. Thanks. And tonight is New Year's Eve, so I am going to go celebrate with the family, and I hope you get the opportunity to celebrate as well. Let's plan on an awesome 2020.